Markets are trying to price an AI earnings boom and a potential energy shock at the same time, and the tension between those forces is now driving almost every major asset class. Welcome to vTalkInsight, Allocator's Lens Daily for May 25th, 2026. Let's start with equities, where index levels tell one story and underlying risk signals tell another. In equities, headline indices remain near all-time highs, with the Dow recently notching fresh records and the S&P 500 tracking one of its longest winning streaks in years. Volatility gauges are back in the mid-teens, so price action still looks calm even as geopolitical and inflation risks accumulate in the background. The backbone of this strength is a very strong earnings season. S&P 500 profit growth is running around 29% versus expectations near 12%, and that follows 6 consecutive quarters of double-digit gains, pointing to genuinely robust corporate fundamentals rather than a simple low base effect. Technology and communications are still the main engine, with sector earnings growth in the mid-50s and AI-linked demand driving outsized gains in semiconductors, servers, and cloud infrastructure. AI infrastructure spending is described as early stage, with data center demand far outstripping supply and inference costs reportedly collapsing by orders of magnitude, which together support the idea of a multi-year CapEx cycle. Importantly, the AI theme is now spilling into adjacent sectors. Industrials, utilities, and companies tied to cooling, power, and battery storage are benefiting from data center build-out, while software and services names like Datadog and Palantir are seeing improved traction as AI moves from hype toward execution in enterprise budgets. Against that, several warning lights are flashing. Semiconductor stocks are up more than 70% year-to-date, trade around 25 times earnings, and nearly all year-to-date gains in U.S. equities come from a small AI and chip cohort, while new AI-themed exchange-traded funds and a prospective SpaceX listing at around 90 times sales highlight frothy pockets and governance concerns. Beneath the surface, there is notable divergence. Asian markets, such as Japan and Taiwan, are hitting records on AI exposure. Small caps and broader emerging markets have delivered strong multi-year returns. Yet Europe is lagging on weak macro data and limited earnings growth, and discretionary stocks show only a minority of names in clear uptrends as the consumer picture stays mixed. Looking ahead, allocators are weighing 2 competing paths for equities. If AI-driven earnings continue to surprise and energy disruptions ease, the current leadership could persist but rotate geographically toward under-owned regions. If, instead, the Strait of Hormuz shock deepens or policy turns more hawkish, today's narrow, AI-heavy leadership and stretched technicals leave room for a sharper correction, making upcoming inflation data, central bank messaging, and Middle East headlines key signposts. Turning to rates, the story is a steady drift toward higher for longer. Markets are steadily pricing out near-term rate cuts, and, in some cases, starting to contemplate renewed hikes as stagflation risks build from persistent energy disruptions and sticky underlying inflation. Recent core inflation has accelerated, with annualized rates over the last 3 months running meaningfully above the 12-month pace, and policymakers are concerned that repeated oil shocks could bleed into core prices. The Federal Reserve is expected to remove its easing bias and keep policy on hold for an extended period, while signaling a willingness to hike if inflation or wages re-accelerate, even as the next actual cut is framed as a story for much later in the decade. At the long end, global yields remain elevated, with U.S., U.K., and Japanese 30-year bonds all near multi-decade highs, and real yields on long-dated treasuries close to previous records, which some see as evidence that policy is not as tight as headline rhetoric suggests. Active managers are reportedly comfortable adding 10-year treasuries above roughly 4.33%, citing attractive real income and potential flight to quality demand, while shorter-dated money market products still offer yields near 3% with low interest rate risk. In Europe, by contrast, government bond yields have edged lower as weaker growth data and declining oil prices this week offset concerns about future energy shocks, with official forecasts now marking higher inflation but softer GDP. Across markets, curves are sending a mixed message of higher front-end yields and, in places, softer long-end yields, consistent with rising stagflation anxiety, which is why upcoming personal consumption expenditures inflation data and fresh Fed commentary are seen as pivotal for both bond pricing and broader risk sentiment. Credit has so far ridden on the coattails of strong corporate earnings, with spreads still tight and balance sheets generally described as sound. However, there are growing signs that financial conditions are tightening, particularly in Europe, where bank lending managers report pulling back on new credit, raising the risk of sharply slowing growth or even mildly negative GDP momentum. Stress is more visible in emerging markets. Indonesia and the Philippines have moved to raise rates. Several Asian currencies are under pressure from high energy import bills, and Turkey faces acute currency and equity market weakness despite heavy intervention, with political turmoil and reliance on Iranian energy imports amplifying perceived credit risk. In private credit, caution is evident in moves like JP Morgan seeking to transfer risk from billions of dollars of loans backed by private equity funds, highlighting concerns around net asset value financing in a higher yield, slower growth backdrop. For multi-asset allocators, the message from credit is that carry still looks attractive on the surface, but the combination of bank retrenchment, emerging market vulnerability, and complex private structures means that spread widening could be delayed but sharp once defaults or downgrades materialize. In foreign exchange, the dominant pattern is a split between energy exporters and importers. Currencies of commodity and oil exporters, such as Brazil and Colombia, are holding up relatively well, while importers including Korea, Thailand, and the Philippines are under significant pressure as the energy shock raises import costs and current account strains. Even where the dollar rally has cooled, several emerging currencies like the Indian rupee and Korean won are hitting record lows, suggesting that oil prices now matter more than the broad dollar trend and prompting interventions from local central banks. Turkey is a more extreme case, with the lira sliding despite large-scale foreign exchange operations and policy tweaks, underlining how political risk and external funding needs can interact in a high energy price environment. The Japanese yen remains very weak, hovering near levels that previously triggered sizable intervention, and thin holiday liquidity raises the chance that any official action could have outsized effects. Commentary also points to a non-trivial risk of coordinated U.S.-Japan foreign exchange intervention, which, together with ongoing debates about longer-term demand for U.S. treasuries, keeps currency markets firmly tied into the wider stories of rates, energy prices, and geopolitical alignment. Commodities, and oil in particular, remain the key swing factor for the entire macro picture. The Strait of Hormuz is partially shut, with a U.S. naval blockade reportedly turning away dozens of tankers and leaving a meaningful share of global daily oil consumption physically unable to move. Yet crude prices have eased this week as traders bet on a diplomatic resolution, suggesting some complacency about tail risks. Scenario analysis around a prolonged closure is sobering. If flows through Hormuz remain impaired into the summer, estimates suggest OECD oil inventories could fall toward roughly 2.2 billion barrels, raising the probability of sharp price spike that might see Brent retest or exceed recent highs and push U.S. gasoline above the $6 mark, particularly if domestic demand cuts into product exports that have so far cushioned global markets. The energy shock is not limited to crude. Gasoline prices are up more than 50% year-to-date, and diesel nearly 60%, while urea fertilizer has risen about 50% since the crisis began, squeezing farmers who also face higher fuel costs and, in the worst case, raising the specter of severe food shortages for tens of millions in vulnerable countries, with estimates of a 0.5 percentage point hit to global GDP via higher inflation and weaker real spending. On top of that, AI-related power demand is stressing electricity grids, with individual data centers expected to consume a striking share of national power in some countries, and permitting constraints plus smelter outages in the Middle East are supporting elevated aluminum prices, benefiting producers like Alcoa. Putting it together, commodities sit at the fulcrum of today's cross-asset setup. A clear de-escalation in the Gulf could release an energy risk premium and reshape regional equity leadership, whereas a prolonged or worsening disruption would harden stagflation, keep central banks cautious, and eventually challenge the resilience we still see in risk assets. Stepping back, the cross-asset picture is defined by a clash between powerful AI-driven earnings and a potential energy shock that keeps inflation and rate risks alive. Equities continue to lean on exceptional profit growth and technology leadership, even as leadership narrows and valuations in some stories look stretched, Rates are edging toward a higher for longer equilibrium. Credit still offers carry, but shows more stress at the periphery. Foreign exchange is fragmenting along energy exposure and intervention risk, and commodities, anchored by oil and fertilizers, remain the pressure point that can quickly reprice growth, inflation, and policy. Expectations. For allocators, the key is to watch how Middle East developments, upcoming PCE inflation data, central bank communication, and fragile emerging market currencies interact, because those are the catalysts most likely to shift the current balance between resilience and vulnerability across assets. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.